The fourth quarter of FY20 was most eventful for life insurance companies impacted by various events. Let's do a 3-point analysis to understand which one should investors keep their focus on. 1. Impact of budget proposals and reinsurance rate hike. Well, the union budget had proposed an alternative tax regime that allows no exemptions and deductions but offers a lower tax rate. Now, there are concerns that this could impact the future demand of life insurance products or general insurance products. However, both the insurers have said that the alternative tax regime would not impact them materially, as the industry as a whole has moved away from a predominantly tax exemption driven sales approach. Now, the budget also proposed the removal of the DDT or the Dividend Distribution Tax and made dividends taxable at the hands of the recipient, which adversely impacted margins, growth, and also return of both life insurances. Now, during the quarter, reinsurers hiked their rates. Around 50% of the sum assured in the retail protection business, pure term insurance, is usually reinsured. ICICI Pru and HDFC Life responded differently to reinsurance rates hikes or rates going up. Now, ICICI Pru has revised the pricing by increasing premium for protection business that fully absorbs the changes in the reinsurance rates, such that the margins are maintained at the same level. In contrast, HDFC Life has not yet passed on the reinsurance rate hikes to customers. Rather, it will look to maintain margins by bringing down the acquisition costs and retaining the book rather than reinsuring it. 2. Impact of COVID-19. Well, the outbreak of COVID-19 has a significant impact on business, margins, returns, and solvency of the insurance companies. New policy sales were severely impacted in March as the country entered the lockdown. Now, apart from this, according to HDFC Life, it did see a business hit to the tune of around 600 crore rupees in terms of renewal premium, and also 400 to 500 crores in the new business premium. ICICI Pru is now using digital sales methods such as video calling, chatbots, telemedicals to drive the customer sales and servicing. Now, in addition to the business, COVID-19 has a significant impact on the investment returns. Now, as far as the asset side is concerned, HDFC Life made 106 crore rupees provision on Yes Bank AT1 bonds. Now, ICICI Pru, for that, it has not invested in a single defaulting security over the last 20 years, which is a big positive. On the liability side as well, ICICI Pru is well placed to tide through the market volatility. Both the life insurers reported investment loss in FY20 against the gain in FY19. Now, instances of insurance claims for COVID-19 are minuscule so far. Despite the adverse scenarios, both the leading private players, ICICI Prudential Life and HDFC Life, have seen acceleration in profitability yardsticks in FY20, such as improvement in the new business margins driven by higher persistency, lower expenses, and also an evolving product mix. 3. Where should investors put their focus on, or where should you invest? Well, around 65 to 75% of the value of life insurance companies comes from the future new business value, VNB, and hence it remains the most important metric. While both HDFC Life and ICICI Pru have shown accelerated growth here, ICICI Pru has guided to double the new business value by FY23, implying a compounded growth rate of 19% per annum. In FY20, ICICI Pru saw the new business value grow by about 21%, which was very encouraging. Now, amongst the two players, ICICI Pru's business growth was slower than HDFC Life in FY20, with APE, or the annualized premium equivalent, falling by 5%. That is because it saw degrowth in traditional ULIP business, but high margin protection business growth for ICICI Pru was very high. The new value business margins and the ROEV, or the return on embedded value, at HDFC Life are the highest in the sector. But having acknowledged all these positives, the premium valuation of HDFC Life leaves us with cold feet. HDFC Life is trading at 4.7 times FY20 price to embedded value. ICICI Pru's stock is currently trading at 2.3 times FY20 price to embedded value, which is a significant discount to HDFC Life. Now, we do see this as an opportunity for the investors. The best time to buy a stock during a downturn is when it is really beaten down. ICICI is well on track to double the value of its new business, improve the business mix in favor of protection business, and consequently also generate better margins and return going forward. So investors wanting to participate in the insurance growth story can do so by investing in ICICI Pru, which is available at a relatively compelling valuation.